Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets.
New York coffee. The pipe tops formed on the 9th and 12th of September last year were the direct triggers for the move lower that was seen until January this year. The actual pattern that sets up for the move lower, the lopsided diamond pattern seen disappearing up in the top left of my daily chart and highlighted in dark blue, is huge. I'd previously given a primary target for this in the 166 3/4 area, with a secondary harder to achieve target X1 in the 142.40 area. The primary target was achieved in early November and the harder to reach secondary target X1. Well, we came awfully close to it in early January, but the congestion around the 2019 high at 142.45 and the September 2017 high at 143.35 proved to be too much for this attempt lower, and we dodged it, but only just. I'm still calling it live for now. I said at the time when indicating these targets many months ago, and I quote, "There is one other fly in the ointment. Perhaps, just perhaps, the lopsided diamond pattern is becoming a big bear channel. If that is to be the case, then the first area to look at below will be the lower bear channel line of such a pattern. Currently that's at 161.50, and that's the end of the quote. The extension of this bear channel is highlighted in bright green on my daily chart, and the lower bear channel line has played a significant part in recent actions. The core of the real resistance nearby had been the nearby 50% Fibonacci line of the May 2019 to February 2022 move at 174, which I've highlighted in purple on my daily chart. This was breached, let's say even broken last week with the move higher, but the combination below the 50% Fibonacci line of the declining medium moving average, currently 176.95, the 50% Fibonacci line, the June 20 to February 22 move at 177.45, as well as the August 21 lower 174.5 to the 2016 high at 179.55, and finally the 2015 high at 187.40, all managed to halt the rise and turn prices lower again, though the market is still negotiating with the 50% Fibonacci line at 174 even today. On the overall action, I spoke about this in early December 2022, that perhaps all this drop and sideways to up action may be turning the market into a descending scallop pattern, especially after looking at London coffee, where this seems a reasonable idea. Well, I still hold to this idea, which may surprise you, but I'll explain why shortly. Though the fall since the start of this year was in line with the bearish move to the descending scallop, including my layouts of a primary target X in the 128.5 zone and a secondary harder reach target, a much harder reach target X2 way down in the 78.5 zone and off the bottom of my daily chart, despite laying these targets out, I still hold to the idea of a possible descending scallop pattern, as this pattern, as I said last week, and I quote, can also have an upward breakout. But, as an important but it will depend on what the market does should it get to the key 50% Fibonacci line of the May 2019 to February 2022 move at 174. For the moment, I'll leave the targets where they are below, but they could easily be retired on confirmed moves higher over the 50% Fibonacci line. End of quote. This led last week to an interesting pattern I spoke about last week also. You see, last month was a monthly key reversal up. This longer term pattern has yet to feed into the daily actions, but it brings me closer to looking at potential targets above for the descending scallop pattern and potentially retiring the ones below. London coffee. The lower time, currently 1686 of the late December 2021 to mid-July 2022 bearish Andrews pitchfork, which I've conveniently highlighted in dark blue on my daily chart, was where the current rally started back in mid-November last year. Seen the market since then curl upwards, show some indecision, especially just over the 2018 high 1845 and under the congestion at 1897, till in the second week of January we saw a weekly key reversal up that punched up through the congestion at 1897. Thus we come to my commentary from 9 weeks ago when I put forward a new suggestion of what may be happening. You see, looking here at London and also at the New York contract, I suspect the action since mid-October may be a descending scallop pattern, sometimes called a backwards letter J pattern. Here on the London contract, especially on the London contract, this pattern has merit. So here are just the primary targets, both above, as we seem to be having a follow through higher now. But just in case, I've also included the primary target below as well. Okay, so top side, primary target X would be in the 2095 area with a harder, much harder to reach potential topside secondary target X1 in the 2280 area, where the 2017 high is. As I said last week about target X, and I quote, "This is a doable action, especially as prices have pushed up through a lot of resistance. There's now support starting from the middle time, currently at 1922, as well as the separate congestion at 1945 to 47, and then more from 1968 up to 2004, end of quote. Last week prices punched up through the super significant resistance of the long moving average, currently at 2024, as well as the September 2017 high at 2038, the necklines of the November 21 to February 22 and August to September 22 head and shoulders tops, currently 2032 and 2050 respectively, plus finally the 50% Fibonacci line of the August to December 2021 move at 2064. The market managed to do all that, but it failed to reach up that little bit extra to 2095. I suppose I shouldn't be surprised, as prices managed to punch up through a hell of a lot of resistances. So that small extra step was just a little too far last week. But the overall movement is still higher, and that is why target X at 2095 and even target X1 at 2280 are both still live. They are still in the frame.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.